Okay, check this out, right? What if I told you that prime borrowers for auto loans were at delinquency levels not seen since the heights of the '09 recession? What if I told you stocks made a new all-time high today? Yeah. What would you think? Give you a second. Let me know down below in the comment section, because that's exactly what's happening. And just so you know, prime borrowers for auto loans is a credit score between 661 and 780. That's about 80 to 85% of the total volume of auto loans. That range of demographics is starting to default in which you have not seen since the heights of the Great Recession. Now, take a listen to this clip from CNBC that says, take auto loan defaults with a grain of salt and read on overall consumer health. It says UBS.
It says to take the milestone with a grain of salt. UBS head of credit strategy, Matt Mish, joins us now. How severe are these delinquencies?
Well, I think, certainly you've seen two things that I think are notable. One is we're not just talking about subprime ABS delinquencies anymore that are near elevated levels. We're talking about prime, right? And about 80 to 85% of all auto loans or financing for an auto purchase essentially are prime. The second thing I would say is that, again, these levels have been certainly elevated relative to the last, call it 3 to 5 years. But what we've really seen is a notable uptick. And again, you are approaching 2009 levels. Now, having said that, we do think that investors should take this with a grain of salt, particularly in terms of the read for the overall consumer health. And there's a few reasons for that. One is that net losses are not keeping up at the same rate as the delinquency surge that you're seeing. And a lot of this, we believe, is due to something called churning. That's when consumers miss a payment or two on an auto loan and then start to repay. And so there's some underlying fragility, but ultimately consumers want to keep the car and are basically making payments after missing a few. The second I would just say is that non-revolving credit growth remains fairly strong. Through July, it ticked up a couple of percentage points to about 5% year on year. And revolving credit growth as well is also fairly stable. And the last point really is that overall, we believe that auto loans account for about 9% of household debt, 4% of bank loans in the U.S. And so, this is an area where obviously, crises don't strike twice, so to speak. Housing is not going to be the problem. The areas that are of concern are really consumer loans within household credit, and autos is certainly, as well as credit cards, in focus right now.
And those aren't as bad? Is that what you're saying in terms of delinquencies, defaults?
Those are not. I mean, mortgage delinquencies are increasing, but still about a standard deviation below average. And keep in mind that mortgage credit is about 70% of total household debt. And so, from our side, what we did was downgrade our view for high grade and high yield auto credit to underweight. But we didn't necessarily change the overall softish landing that we have on the consumer because I think it's too early. There's enough data points that suggest this is not necessarily, as you say, a canary in the coal mine that investors should seize upon.
Still, it's a risk. And I do wonder, Matt, if you see it priced into the financials at this point. I remember that Ally warning a few weeks ago at the Barclays Financial Conference of credit challenges, especially tied to autos, is in the banks.
Yes, I think, from our standpoint, we downgraded the high yield financial sector to neutral. I think you have to separate banks from the rest of the financial sector. But I do think that there'll be some challenges going into third quarter earnings. We've seen that with some other cyclical names like KB Home overnight. And so, I do think that if this is a credit cycle as it normally plays out, where those areas that are more vulnerable start to deteriorate first, certainly higher beta or lower quality credit or names in the stock market In those areas that people are looking for more pressure, again, within household debt, we would say it's not going to be mortgage credit this time. It's really going to be consumer credit. These are areas that you would expect, and I think we will see some pressure as we go through the next few months, particularly given while the Fed is cutting, interest rates are still restrictive.
I don't know where you guys are from, but where I'm from, people do not default on their car as a first alternative. Okay, yes, you're going to default on your car before you default on your home. But if you don't have a car, you don't have a job, you can't take your kids to school or to go anywhere, do anything, no doctor's appointments, no dentist appointments. Like, you don't just default on your car because you feel like it, okay? You default on your car because you have no other option. It is physically impossible for you to pay your car payment. I don't know. This is getting kind of strange, guys. I'm not gonna lie to you. I don't know when the day of reckoning is coming for markets, but it sure seems like it's fast approaching. Fundstrat and Tom Lee on X write, September top stock ideas and super SMID granny technicals. 3 facts drive bigger picture into year end. Stay on target. After falling 4% in the first week of September, the S&P 500 has managed to climb back steadily and is up 1.5% for the month. This is a sign of a strong market, marking the S&P 500 to be up 8 of the last 9 months in 2024. Did get a little bit of good news today and some bad news. Now, Wednesday today was really the slow day for economic data. Okay, there just wasn't much happening today, wasn't much scheduled to happen today, but you did get new home sales. We were expecting 0.70 million, so around 700,000 homes to be sold in the last month in August. We came in at 0.716 million, so about 16,000 higher than expected. That's a good sign. Now, last month we were at 0.739 million, and we actually went up to 0.751 million. So actually went up about 11,000 additional homes that were sold last month in that upward revision. Now, new home sales month over month came in at negative 4.7%, but the forecast was negative 5.1%. So we actually beat the forecast. We beat the estimate. Last month, we were at 10.6% positive month over month, and we were revised lower to 10.3% positive month over month. This, I do think, is the only upside catalyst I can really see to the economy at this point. I think everything else is priced to perfection, besides if the real estate market starts to get moving. If you start to see people actually able to sell their homes and buy a new home, realize that equity gain, take that money to the bank and start spending in the economy is a massive source of potential stimulus. We're talking trillions of dollars in household net worth is in people's homes. And it says here the average homeowner currently has $299,000 in home equity, about $193,000 of which is tappable home equity. So if you go to get like a home equity line of credit, a HELOC, well, that is a variable rate loan, okay? It's not a fixed rate, and it's really dependent on interest rates. So hopefully the Fed cuts rates as fast as we possibly allow them, because the Fed does what the markets price in, and starts to get real estate moving. Even if people do not sell their homes, if rates come down to a more affordable level, people might start to tap that equity, and that could be a big source of spending. That would be like giving, 50% of households, because let's say the average is, it's closer to like 65% of households are homeowners, right? If you give 65% of America, let's say, $300,000, that is massive. Now, even if 10% of the 65% of overall homeowners take out a line of credit, that's still trillions of dollars we're talking about here. And I like to point this out about real estate because nobody really is talking about it. But if we are going to get an upside surprise to economic activity, the only area that I see that coming from is real estate. So it's something I am personally watching pretty closely. As I have reported to you guys previously, the amount of homes listed since February, March of 2022 is up almost 3x. So you've almost tripled from 346,000 homes that were listed to now 909,000 homes listed. And from the latest data that we're seeing, you're really not seeing an uptick in mortgage applications. People are not filing to get a new home yet. And I think that's because rates are just too high. It's still unaffordable. But as rates start to fall, if you start to see mortgage applications pick up, then maybe that can help offset some of the negative price implications that rise in inventory has. Because let's face it, a 300% rise in inventory of anything coupled with a say 60% decline in available purchasers, which is represented here in the decline of mortgage applications, will have a negative impact on price. Now, real estate moves very slow. So eventually you will see this reflective, okay? You will see prices of homes fall, but if rates fall fast enough and we can offset that quick enough, then maybe it won't be as bad as it maybe otherwise would be. But here's the bad news. US August median sale price was $420,600, down 4.6% from August of 2023, which it was $440,900. So you're actually down about $20,300 or so year over year in the average selling price of a home. So prices are actively starting to fall. And again, what I mean by markets just being priced for perfection is this. I mean, you are 2 standard deviations higher than the historical average for the S&P 500 price to sales, okay? You're back into periods in time like the late 50s, early 60s when you had poor forward returns. You're back to .com, bubble peaks. You're back to 2021 peaks, and you're there again. I mean, does valuation still matter, or does it not matter? Let me know down below in the comment section. Kobisi Letter writes on X, current situation. Stocks are rising like a soft landing has happened. Gold is rising like we are in a major economic crisis. Bonds are falling like the Fed is done cutting rates. Real estate prices are rising like rate cuts just started. Oil prices are falling like demand is disappearing. Natural gas prices are rising like demand is growing. Nothing adds up here. Lisa on X writes, some are stressing the importance of yesterday's Conference Board labor differential reading, which fell to its lowest since March of 2021. Citi's Hollenhorst says, quote, a variety of indicators confirm that the labor market is at risk of entering in a period of a more rapid weakening. I think this was a great chart as well that was put together by Jeff Winiger. He says, look at this waterfall in the Conference Board's leading economic indicators divided by lagging indicators. We have seen 8 plunges like this since the 1960s, and each one flagged a recession. So this is actually something that tends to happen before you go into a recession, is when you start to see this large plunge. And you've been seeing this plunge for a while now. Like this is really not anything new. But I think it just speaks to maybe the weakness we've seen in the economy for a while, at least the last couple of months. I have personally seen in my business contacts have told me that they are seeing a severe slowdown in people spending money, but it's not being reflected in the data yet. And that's why I do think the government economic data is just very lagged behind, because what I'm seeing, what I'm hearing out there from my contacts is things are not good. And things look okay in the government economic data. There is a big disparity between Main Street, what Main Street is feeling, and what Wall Street is seeing. But again, this would suggest that maybe we are closer to a recession than we actually think. And back here in 2007, right, you actually hit the peak around 2006. And then it took almost 2 years to go into that actual recession, which is roughly right on track with where we are now. If we hit that peak roughly in 2022, then, it's 2024, almost 2025, almost 3 years later, and we could be entering into that recession. Now, kind of to the same point the Kobisi letter was just making is this chart, which is kind of crazy. This is showing the price of gold over time since 76, if you will, up to where we are now. And it says 14% of gold's record closing highs since 1976 have occurred this year. Now, the last time you've seen this was during the 08 to really 010 recession, right? And it was late 2007. We were declared in a recession, and it was really late 2009 when we actually came out of that, early 2010. But that's where you've seen the last big rally in gold. Gold is literally saying that we have an economic crisis on our hands and nobody's paying attention. Mac10 writes on X, the chart that no bull wants to see. It's time for a haircut. And yeah, if this is the .com bubble, this was the housing bubble, I would say this is definitely due for a haircut. Now, I don't think it's going to be 50% or anything like that, but I do think a 30 to 40% decline from here would make a lot of sense to just send us back to a more reasonable level. Renaissance Macro Research says while mortgage purchase applications crept up in the latest week, the decline in mortgage interest rates so far has helped push up mortgage refinancing. Year to date, refinancing is up over 200%, while purchase applications are up about 5%. Jay Antoni on X writes, Richmond Fed Manufacturing Index is having its worst month since the depths of the COVID lockdowns, as new orders continue plunging. Layoffs are now so widespread with so little hiring that the employment index is below even the COVID lockdowns. It's the worst reading since 2009. Factory jobs, aka manufacturing jobs, hence the manufacturing, is starting to just hemorrhage. Okay, these jobs are in danger of rapidly dissolving, and that is a major problem. But it makes sense with the cycle that we've seen, right? There was a big push to goods, and there was a big push to hire a lot of people to manufacture those goods for people to buy. Now that people have really stopped buying goods over the past year, now companies realize they don't need as many people, and they're starting to fire people. And that's just the unfortunate, cycle that we are in. And unfortunately, it looks like it's going to get a lot worse before it gets better. Just to make matters even worse, Biden said an all-out war is possible in the Middle East, but there's also a possibility of a settlement. Michael J. Kramer on X writes, earnings estimates for 2024 and 2025 fell again today for the S&P 500. I guess we will find out really soon if fundamentals really do matter. My guess, they do. And you can see that reflected here in the chart. For 2025 year-end estimates, they have fallen from what was about $276 per share down to $274.42 per share. So we'll see. I don't know. Again, let me know if you think valuations even matter anymore. Because in the face of a clear recession that is coming, you still have people that are just, giddy about buying markets at these valuations. Like, do valuations matter? I think they do and they should. But right now, people are acting as if valuations do not matter. Robin Brooks on X writes, global recession risk is rising sharply. The forward-looking orders inventories component in the S&P Global Manufacturing PMIs is going negative all over the place. For the US in red, it just fell to a more negative level than in late 2022, right after Russia invaded Ukraine. So rising orders and lower inventories, well, you're seeing orders fall and inventories rise. Now here on the day today, this CNN Fear and Greed Index is sitting at 67. Yesterday it was at 65. So even though markets are down about 1/3 for the S&P 500 at the time of recording this video, you're still seeing the Fear and Greed Index that's actually moving higher today, which is quite fascinating. The percent of stocks currently trading above their 50-day moving average has broken down to a recent low of 58.36%. Now, yes, this is subjective because by recent I mean since the Fed cut rates 50 basis points. This is the lowest kind of your average stock has been or has started to go. Today, you're seeing almost 3% of all stocks breaking below their 50-day moving average. So it's not a terrible day. It's a bad day. Not a terrible day. And definitely not a good day. And your treasury yields today are rising about 4 basis points. It doesn't seem like there's a real clear reason for this. It could be some of the Chinese stimulus that we seen yesterday and some of the fears that we may see more inflation now. That's my best guess, but there's not a clear reason to why this is happening. The 2 and 10-year yield curve inversion is also uninverted now, 23 basis points, which it's basically been just going parabolic in the last couple of weeks. Really the last 2 weeks or so, this thing has went from inverted to almost positive 0.25%. So let me know what you think about this information down below in the comment section. Big question is, do valuations matter anymore? Or is valuations just a thing of the past? Let me know your thoughts down below in the comment section because, again, just to be honest, markets are acting as if valuations do not matter. I think they do, but hey, what do I know? So let me know your thoughts down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.